Good day. This is Mr. Moibi, the account teacher. So the topic we are going to look at today is Nigeria financial system. So we are going to look at this topic. But before we proceed, I would like to share this lesson objective with you. The lesson objective, at the end of the lesson, students should be able to define Nigeria financial system, state the functions of Nigeria financial system, describe the financial intermediaries, then explain the financial assets. So we are all going to look at this one today. So let us look at financial system. Financial system is also the financial intermediaries, markets, rules, and regulation instrument that regulate and guide the flow of fund from one unit to another. So the flow of funds needs to be guided by the Nigerian financial system. So they make sure that all these are they regulate and they make sure that the rules are being guided by the uh, by the Nigerian financial system. So they ensure that all these are being monitored and follow, and they also regulate and control the financial system. So a country financial system must be sound to ensure free flow. So it must be something that will be sound and ensure that the funds are being free from flow from one place to another, from the suppliers to the fundraisers, from the supplier of fund and fundraiser. And this will help to serve the needs of the economy. So they also use it to serve the need of the economy, to make sure that they provide and ensure that the economic is being developed and the growth of the economy is being attained. So they make sure that the financial system is being uh, controlled by the by the Nigeria economy. So then let us look at the functions of financial system. One, provision of market mechanism. The financial system provides a mechanism that ensures interaction between users. So there will be interaction between the users and the supplier of fund. So the users of the fund and the supplier of the fund, there should be interaction between both of them. Then second one is financial intermediation. This is a transfer of fund from uh, one area of surplus to where it will be scarce. So they make sure that they transfer fund to where by they are in need of this fund. So where they are in need of this fund is a place where the fund is being scarce. So financial system link the supplier of fund with users of fund. There should be interrelationship between the supplier of fund and the users of fund, because both of them need to interact. The amount of the money that the users of fund will collect, we collect from the supplier of fund, then the payment of that fund as well. So there should be an agreement between both parties. So and the payment of the fund as well. So they need to reconcile and look at when they are going to pay back the fund that the users is about to collect from the supplier of fund. Then provision of rules and regulations. The system provide the rules. That should be rules and regulation. Yes, that should be rules and regulation norms and the rules, norms and regulation that will facilitate and regulate the flow of fund. So the both parties need to look at it. The rule and regulation will be there so that both parties will not violate the these rules and regulation. So then we will also want to look at uh, the provide for pricing mechanism, and these are inbuilt mechanisms in the system which moderate and regulate the pricing of financial instruments. So they make sure that financial instruments are being regulated. So they regulate financial instruments, and these instruments are those things that they are using in the financial system. So mobilization of fund. The market helps to mobilize fund, a surplus fund, as savings. So when there is surplus fund, they make sure that they are keep in a saving area. So they make sure that they help to mobilize surplus fund, and that surplus fund they use them for saving. Then provision of facility for flow of fund. So they provide all the necessary facilities for the custody and marketing of financial assets. So they make sure that they provide necessary facilities for the marketing of financial assets. So let us look at the other one, financial intermediaries. Let us look at financial intermediaries. There's the intermediary between the supplier of funds and the users of funds. These are institutions that facilitate all transactions that occur in the financial statement and financial system. So is the financial intermediary just an institutions? Maybe it may be banks, it may be financial houses. So let us look at the example of there should be intermediaries between the supplier of fund and the users of fund. So this is the term used to include financial institutions engaged in from borrowing borrowers and lenders. So intermediary between the borrowers and the lenders. So the interaction was, all these are the interaction here. Intermediaries. So the intermediaries are commercial banks, or you can also call it investment trust bank, merchant banks, development banks, specialized bank, primary mortgage bank, insurance companies, pension fund managers. All these are intermediaries. Intermediary between the supplier of fund, that is financial institutions, and the users of fund. So these are the intermediaries between them. Then financial asset. Let us look at the financial asset. These are financial instruments that are traded in the market. I say just financial asset, just an instrument that are placed on for buying and selling of securities in the market. So then this constitutes the documentary evidence. It's an evidence when you're talking about financial assets. It's just an evidence. Then what are these financial assets? We are talking about money. We are talking about securities. This security giving a claim to receive money. We have bills. We have shares. These are given as indirect ownership of physical and financial assets of companies. So under this financial asset, we have denominated in currency. Denominated in currency, financial assets are expressed in the currency of the country. Like this country, Nigeria now, we recognize Naira as our currency. The common denomination is the current of the nation where it is raised. So where it is raised, that is if they raise a currency here, or the currency, that's the currency of this country is Naira, and let me say a kobo. Then we also have liquidity. Liquidity, I've told you the other time, liquidity is just, a debt, or you can call it liabilities or obligations. So financial assets are easily convertible to cash with little or no risk of loss. So that is for the liquidity. Then we have divisibility. These are usually denominated depending on the face value used by the organization. So they make sure that the denomination are being divided into different parts. We have different currency. We have 1,000 naira, we have 500 naira, we have 200 naira, and so on. So predictable returns. The assets are predictable for the purpose of they are patronized by investors. So they make sure that they predict assets. Some financial users predict the asset of the company by using their financial reports. So that is about the financial assets. Then let us look at the financial market. Financial markets are being classified into two. We have capital market and money market. Capital market, these are the various institutions provided by the financial system for the creation, custom, and distribution of financial assets. When we are talking about the capital market, these are the market that provided long-term investment, or long-term loan. So, and the repayment will be for more than 1 year. So you can pay that money, you can pay the loan that you've collected from the bank or any other financial institutions after more than 1 year. But under the money market is just a soft loan for short-term loan. So whereby you can pay this loan within a year. So that is for the, and it's also an organized network of institutions that facilitate the purchase and sales of financial assets. So they also allow them in this market for buying and selling of financial assets. The market helps to mobilize funds from surplus unit of the society to the deficit unit of the society. So the surplus unit of society, they make sure that they mobilize, the market help them to provide enough fund to the deficit unit of the society. Deficit simply means loss, and surplus means profit. So that's what any society, any business organization that is making profit, they make sure that this financial market provide enough for those markets that are making that are really making profit to those markets that are making loss all the time. So they provide these essential services to the to this financial market. Then we also have functions of financial market. One, saving mobilization. The primary function of the financial market is to mobilize surplus funds. So they make sure that they move the surplus fund, they mobilize it and use it judiciously in the financial market. These funds are later invested. So, and this fund, they make sure that under the saving mobilization, they make sure that they place them on investment. So, provision of credit. Another function of the financial market is to provide loans to individuals. They provide credit. When we are talking about credit, we are talking about loans. They provide loans to individuals, businesses, and government. And such loans can be used for business expansion and development projects. So the loan that they provide for the individuals, businesses, and government, they use it to expand their business and also develop their capital project. So before loan, I need to say this, before loan will be given to you, you must have what is called property, landed property, or collateral security. So in case when you default, when you're unable to pay, and when you're unable to pay, that property will be is going to be it will stand in for the loan that you have collected from the bank. In case when you're unable to pay the assets, they can dispose them of. So you can't just walk into the bank and request for loan. It is not possible for you to, because I have to tell you. So, and you must know that as well. So next one is diversification of risk. Yes, that is what our government like to do. Our government don't like to diversify the economy to another sector. So, and any place, anywhere they depend on mono economy, whereby we produce only one product in the country, there will be a lot of risk. Then the country will be in a mess as this country, as we find ourselves in this particular country. So diversification means to combine risk into a portfolio. When this is done, the total risk is reduced. So if the government can do the same thing, they make sure that they diversify our economy to another sector, then the poverty in the country, then the total risk in the country will be gradually reduced. So simply because any loss that occurs in one investment is offset by gain in another investment. So then transmutation function, the financial market asset fund from surplus units, and then they package the fund and lend to borrowers or deficit unit. So that is what they does under the financial market. Then we also have liquidity mechanism. It ensures that financial assets are actually convertible to cash without loss of value. So they make sure that cash are easily converted, the financial assets are easily converted into cash. Financial assets, maybe it may be when you're talking about financial assets, you're talking about buildings, you're talking about plant machinery, you're talking about motor vehicles, they can dispose them of and they turn them to the liquid cash. So that is what I'm saying. So it's possible. It is possible under this. Then we also have last one, means of effecting government policy. Government can bring their own policy, and that their own policy may affect the activities of this financial market. The monetary policies of then government are affected, I've said it, by financial intermediaries. Once their policies are fashioned out, the implementation is the and this will wipe out whatever any problem in financial market. So what I'm trying to say is that the government as well, government policy may affect the financial market. So the government need to wipe out their hand from this, whatever their policy, or for the price control as well. So my students, this is what I have for you for the week. That's Nigerian financial system. So please consult your textbook, and the textbook is Simplified and Amplified Bookkeeping and Accounting by Femi Longe. So Steve, keep yourself safe. God bless you.